Hello, this is Seewing Yee from the Year Lucid Network. Thank you for attending. Now, this is a very important. Well, every presentation I, that I make is important, but this is really, really important. I know because you are my so-called members of our Year Lucid Network organization, a lot of these videos and newsletters that you receive on a weekly basis are free of charge. All right, there's a catch. Okay, it's not really free of charge. I my hope is that you're getting these free educational materials, and then in exchange for, look, I'll be honest, to buy investment properties through our network. So when you buy through our network, everybody win, you win, I win, everybody make money. I'll get paid from the real estate partners that we have, sharing their selling commissions, and of course that's the value that we provide as an organization, as an investment club real estate network. Okay, so but that's fine, right? We provide so much value with all these ready-made turnkey properties from different markets, but and our track record over time. But all right, getting back to this. Okay, these three numerical formulas are, I would say, quite important. And although I have presented these through various means, through videos, if you can click on your past emails that you receive, I'm sure I have recorded a similar educational video presentation of how to calculate these formulas. But my my frustration is, to be honest with you, not only newbies out there, but what I found over the years, and I continue to experience it. Many of our so-called savvy and experienced investors who purchase investment properties through our network or otherwise, or maybe not even through our network from other sources, those of you still do not necessarily know how to analyze a investment property, especially from a numerical formula basis. All right. So, I mean, I'm not asking you to become a mathematical or real estate expert, but having a fundamental educational understanding about these three numerical formulas will potentially make or break your realistic future. All right. I don't want to sound so doom and gloom, but sometimes it's nice to buy through emotions. I know emotional decision making is important uh, uh, with respect to real estate investing, but you have to take a step back and understand the logic and the facts behind how to make a decision on a particular property based on these three numerical formulas. Okay, so let's go over them. If I can present it in a different way to enhance your understanding, if you have a after you watch and listen to this presentation, if you can just a light bulb just hit you and just you know then after you watch this, then you get it, you get it afterwards, then it'll make you a more of an informed real estate investor. So when you after you look at each property and just incorporate this three numerical formulas into the equation, then you're gonna have you will have the confidence to pull the trigger, if you will. All right. So, all right. Hope that makes sense. I hope that will provide you with the inspiration and the motivation to take it to the next level. So, without further ado, let me go through each of these three numerical formulas. The first formula is, as you can see right here, is rent to value ratio. And the benchmark is 1%. So let me give you a simple explanation. Let's say you're going to buy a $100,000 investment property. All you have to do is, it's a 1% rule, okay? And a rent to value ratio is nothing more than a 1% rule. 1% rule means 1% multiplied by the purchase price. In this case, in this example, is 100 grand, equal about $1,000 monthly gross rental income before any deductions. And trust me, you don't have to necessarily know the underlying monthly debt obligations and expenses, what have you. By looking at this simple high level number, this 1 grand pretty much represents that you're going to have a positive cash flow, right? Uh, whether you put 20% down payment or 25% down payment or 30% down payment, whether you buy all in cash, you still need to understand the benchmark is 1%, sometimes slightly less. If you buy a property like 150,000 to $200,000 single family home, you may not reach the 1% ratio, maybe a little bit less than 1%. That's fine. But any kind of property you're purchasing, turnkey rental properties, I mean, if it's less than, if it's less than 150 grand, if it's 100,000 or 75,000 or 50,000, it would be nice to have slightly higher than the 1% ratio. Okay, so am I clear? This, it's really very simple. Okay, all right. So one quick thing is, if you buy a single family home that are costing more than $200,000 anywhere in the country, uh, this ratio is not going to work. So what does it mean? That means most likely that property is not attractive in terms of returns, especially if it is way less than 1%. So you need to stick with the real estate market that on a single family home type of properties, less than 200 grand. That's what I'm trying to say. All right. So that pretty much eliminates whole bunch of places in the US. Am I right? Unfortunately, that's the way it is in this current dynamics of the changing real estate market conditions. All right, so let's move on to numerical formula. Number 2 is the capitalization rate, short for cap. What's the cap rate? This number crunching is very, very analytical, okay? The benchmark is around 6% cap rate to achieve positive cash flow. So let me provide you with a definition of the capitalization rate, the cap rate, and why is it so critical. The formula would be is net operating income divided by the purchase price. Okay, I want you to digest this for a moment. Okay, just follow me. Okay, if you have to listen to this video more than once, please feel free to do so. Replay it until you totally get it. You have to listen to it, digest it 1, 2, 3, or 4 different times. Then, repetition. Repetition is the mother of all learnings. All right. So net operating income divided by the purchase price. Let's solve for the net operating income momentarily. Before we go there, you must understand that the mortgage payments are not factored into this calculation. All right. So the cap rate is a cap rate without if you buy with 25% down payment, whatever you have a mortgage, that's not factored in this calculation. Whether you buy all cash, the debt is not factored in. All right, so anyway, let's solve for the net operating income. All right, net operating income is your annual rent minus the annual tax, insurance, and property management fee. Okay. So I might need to go over a sample later on. Let's wait a little bit more. Let's go over that momentarily. And the last, okay. So the cap rate again, 6% is the benchmark. It'll give you positive cash flow. But if you can buy investment property, that will give you a cap rate of 8, 9, 10, 11, 12. If anything more than 10%, wow, you're really going to have a very good cash flow, very good return on your investment. All right, then the last critical formula you must understand is the cash on cash return. And the benchmark is around 11%. So the definition of cash on cash return is your annual net cash flow divided by the total cash down payment if you're doing financing. All right. So it also means how many years of net cash flow you have to wait in order to recoup your initial cash invested. Right. So let me give you an example of a purchase you should not partake. Let me give you not to do. Most of our members are located in the Bay Area, specifically South Bay in San Jose area, which is what. Okay, here's a property that if you, again, just because you live where you live, it does not mean that you need to buy a property close to where you live so you can feel good about it, right? But let me go through this numerical formula. If you were to buy a typical house in San Jose, this house is potentially built in 1930 or 1940, maybe 1,700 square foot, right? Maybe it has been upgraded. Yeah, I'm pretty sure. But the median price of this house, yeah, $1.5 million, and it's not going to get you much, okay, on an average neighborhood in San Jose. Not even the best neighborhood. Purchase price of 1.5 million. If you qualify to get a loan, right, you need to make at least $300,000 salary per year to qualify. At 25% down payment, you need $375,000. Do you have $375,000? No, well, not many people have, but some do. So a whopping almost $400,000 down payment, but the maximum rent is a mere $3,500 per month, right? So minus all your expenses, taxes, insurance, property management fee, if you, and then of course your mortgage payment per month. Then your monthly net cash flow is almost minus $6,000. Okay, and the rent to value ratio is 0.2%, and your cap rate is 5%, I believe. Yeah, and then your cash and cash return is 18%. Oh, negative return on investment, losing money proposition. Okay, so okay, I don't need to go any further. I think I stated my point. Buying a property in San Jose or Bay Area or even California is not a good use of your money based on this analytical metrics, based on common sense, really. All right, so let's not need to go any further. I don't want to rub it on, if you know what I mean. All right, let's get back to a better situation. Go through this all cash purchase of 39,000 in Buffalo, for example. Let's apply the three formulas. Okay, what's going on here? Apply the three formulas. Okay, where's my formula? Okay, here it is. So $39,000 all cash. Oh my goodness, something wrong. Okay, let's not do this. Something's wrong. Okay, let's go over this duplex in Buffalo, $77,000 duplex. What's wrong with my computer? Or forget it. All right, all right. You can check on your own. Right. So the basically is on this duplex rent for $1,400. So the rental value ratio is 1.8%, which is amazing, right? So way more than 1%. 1% multiplied by 77,000 is $770 per month gross rent, but you're getting a gross rent on this duplex of $1,400. So and then the resulting in a capitalization rate of 14.5%, and a cash on cash return of 33%. So getting financing is really leveraging your money, right? And then will provide you with a higher returns because you're not using all of your money. You're only using, a quarter of your money to buy an asset, which is leverage collateralized by the loan, which is a good use of your money. So at the end of the day is, if your monthly net cash flow is a whopping $612 divided by 12 months, right? You're gonna have like almost $8,000 of annual net cash flow. then you put down 25% of 77,000. So you're gonna recoup your money, right? If you look at the cash flow analysis, you can pretty much clearly determine that you can recoup your money within 3 years, right? Because the first year, at the end of the first year, cash on cash return 33%. That means 1/3 of your down payment has been recouped because of the annual net cash flow you're getting. So at the end of the 3 years, right, your down payment you put in for this property has been paid with the 3 years of annual net cash flow, right? That's the cash on cash return, right? So you get the idea how to calculate everything. So I have given you more example for you to look at. So you might want to do some crunching numbers yourself. If you need help, you can always contact me. At the end of the day, I have given you all the definitions of how to calculate each of the three formulas. One is rental value ratio. The benchmark is 1% or more. Second is cap rate. The benchmark is 6% or higher. Go through this simple formula. It's not rocket scientist, okay? If anybody with average intelligence should be able to figure out how to calculate these three numerical formulas. All right. So okay. So that's pretty much I have to say. There's more example for you to evaluate. See, all these potential properties is not hard to figure out the numbers, so you can make informed decisions, take action, and become a real estate entrepreneur, millionaire potentially. Okay, so I hope this another educational value perspective that I'm provided for you. I do not believe if you confine this type of educational materials too many places, right? So by being part of our network, you get the value of my expertise, okay, and everything else associated with tap into our vast number of resources that we have here at the Year Real Estate Network. All right, that's all I have to say, and thank you so much for listening. And I hope this is very helpful to so you can continue to do your research and due diligence and take actions. It's all about taking action, okay? All the knowledge without action is worthless. All right, thank you so much for watching this presentation. Look forward to help you guys to achieve your financial goals. Have a nice day. This is Seewing Yee from the Yee Real Estate Network. Goodbye.